In this video, I feel is important for us to consider the hidden risk of public equity impact investing. While public equity impact investing has many advantages, it also comes with several disadvantages. And so here are some key drawbacks or pitfalls to consider when it comes to public equity impact investing. Number one is a market volatility. When it comes to market volatility here, we are talking about public equities that are subject to market fluctuations, which can affect the financial performance of impact investments, potentially leading to short-term losses. The market is known to be volatile actually, and in that volatile state, there's always that implication of the investor losing money, in the short term, and is a factor one should really consider as an investor. Do you have the capacity to bear market volatility? Because it's part and parcel of what it takes to be an equity investor. Number two is limited control. Investors typically have less control over company operations and decisions compared to private investments, making it challenging to ensure that companies adhere to impact goals. As an investor, your control over the company decision-making process is somewhat limited. And so compared to having a kind of private investments, you can't really control to a larger extent what the company does or what it doesn't as it relates to the impact goals you want to achieve. That is why this aspect of limited control is an important disadvantage of public equity impact investing. Number three is impact dilution. Impact dilution. As companies grow and scale, their original social or environmental mission, may become diluted in favor of profit maximization, leading to a potential misalignment with impact goals. Generally, companies may decide on the onset to pursue and a kind of sustainability agenda. But as time goes on, and these companies become very big, they grow bigger, acquire market shares, and expand geographically. That initial goal may no longer be tenable, may be forgotten, may be neglected or ignored. So in that case, there is that impact dilution coming in. They forsaking their first goals, they forsaking the initial desire to create impact, and are purely driven by profits motives. This is an aspect we should not neglect or ignore. Number four is a greenwashing risk. When it comes to greenwashing, actually, some companies may engage in what is called greenwashing. That is promoting themselves as socially responsible without making significant changes to their practices, making it difficult for investors to identify genuine impacts. So in other words, they are dishing out information that is not in line with what is actually obtainable as far as their operation is concerned. Kind of falsehood, deception, and they can very hardly tell you precisely what is happening in the area of sustainability, because what they are bringing out, what they're putting up there, what they're putting out there is not the actual facts. It's a kind of a deception. Number five is an inconsistent measurement. Inconsistent measurement. The lack of standardized metrics for measuring social and environmental impact can complicate assessments and comparisons across different investments. If you apply the traditional accounting, standard, it's very easy for you to be able to identify progress, profitability, earnings, and other performance parameter. But when it comes to measuring, impact goals, is a bit complicated. Actually, there's no real standard procedure you could adopt to actually measure impacts. It's a kind of, a shade of gray phenomenon. Number six is focus on financial returns. Investors may prioritize financial performance over impacts, leading to a potential conflict between maximizing returns and achieving social objectives. So, if investors in this regard no longer prioritize the impact they need to create, then they will end up focusing purely on financial returns, on financial gains. And in that case, the impact aspect of the investment will surely suffer. It will take a back seat, it may be relegated to the background for purely, profit motives. Number seven is regulatory challenges. Regulatory challenges. So changes in regulations or government policies related to sustainability and impact investing can create uncertainty and affects investment performance. We all know that change is the only constant. And so from time to time, government may bring out policies that may not really, promote the idea of sustainability to the extent it ought to be promoted. And so these regulations could be a significant challenge when it comes to public equity impacts investing. Number eight is short-term mindset. Short-term mindset. While public markets often favor short-term performance, which may conflict with the long-term goals of impact investing, making it harder for companies to invest in in a sustainable manner, to invest in sustainable practices. We discovered that generally speaking, a large number of equity investors are there for the short term returns, the short term performance, and the short term gains. So, as an impact-oriented investor, you can't afford to adopt this particular mindset. Okay, and so if you have that short-termism, in your mindset, you will not be able to actually, achieve your goal as an impact investor. And so, going for public equity impact investing, is a challenge because when it comes to public equity, generally, that idea of short-term that short-term oriented, concept is quite pervasive. It's quite prominent in this kind of investing. Number eight is high competition, or number nine rather is high competition. As the popularity of impact investing grows, our competition for high impact investment opportunities increases, potentially driving up valuations and reducing returns. And this particular concept of impact investing is really gaining ground. It's becoming more popular and is becoming like widely adopted by a vast majority of a vast number of investors. And so as people pile into this particular concept, you discover that asset prices or equity prices would then be kind of overvalued, all right, because of the competitive nature of this kind of investing. And so the number of people who are willing to invest ethically, who are willing to invest, in a sustainable pattern, then that will drive valuation further. And by so doing, the returns will naturally, plummet. Number 10 is limited availability of options. Although the number of impact-focused public companies is increasing, the overall pool of available investment options may still be limited compared to traditional investing. Although this particular concept is gaining ground, as we all know, but yet you cannot compare the opportunity in impact investing to what is obtainable in traditional equity, shares, stock markets, and investing. These disadvantages highlights the complexity and challenges investors face, in public equity investing, emphasizing the need for careful research and due diligence before you, commit your hard-earned money into this particular strategy.